bottom line. Finance only approves what it can prove. So in the next 5 minutes, we're going to walk through the CFO-proof way to calculate AI's return on investment, lock in a fast payback, and, most importantly, de-risk your projects right from the get-go. All right, let's kick things off with a pretty sobering number. And this comes from research out of MIT, which paints a really stark picture of the AI landscape right now. Get this, a staggering 95% of all AI projects, they just don't hit their financial targets. And we're not talking about a small miss here. This is a huge quantifiable problem that has boardrooms asking some really tough questions, like, what are we actually getting for all this investment? So the big question is, how do you make sure your project delivers real, measurable value? How do you join that successful 5%? Well, it all starts with building what we call a CFO-proof framework. Okay, before we jump into the solution, we really need to get our heads around the core challenge here. You see, for finance leaders, AI investments are just different. They're dynamic, the returns aren't always a sure thing, and honestly, success is just as much about your company culture as it is about the tech. To get this right, we've got to speak the language of finance. So we're going to ground our whole analysis in 4 key metrics. ROI, that's return on investment, TCO, total cost of ownership, net present value, and the internal rate of return. Now, the basic ROI formula, it looks pretty straightforward, right? But with an AI project, the real challenge is nailing down what net gain actually means and what the full investment cost is. And believe me, getting those 2 variables right, that's the whole ballgame. Okay, so let's build that defensible method. Here's a structured framework that you can use to prove the value of any AI initiative every single time. We've broken this down into 5 really clear, manageable steps. This is how you turn those kind of vague goals into a rock-solid financial model that can actually withstand some serious scrutiny. So let's walk through them. So here's how it works. First up, you've got to define one single key performance indicator, or KPI. That way, success is totally unambiguous. Second, you establish your current baseline, so you know what you're measuring against. Third, and this is a big one, you calculate the true total cost of ownership. And that means including all those often missed hidden costs. Fourth, you build out your financial model. And finally, you stress test every single assumption with a sensitivity analysis. This is how you really understand your risk. But a truly CFO-proof model has to go even deeper. It's not enough to just look at the basics. You have to account for all capital and operational expenses. That's CapEx and OpEx. And crucially, you absolutely must budget for the recurring cost of retraining your AI model. If you don't, its performance will drift over time, guaranteed. You know, a fast payback period is always going to be compelling to a CFO. This calculation shows you exactly how quickly the project pays for itself. And a good rule of thumb, anything under 12 months is very attractive. Now, for even more precision, we also like to model the discounted payback period, which cleverly accounts for the time value of money. Then there's net present value, or NPV. This one just cuts right through all the noise. Think of it this way. A positive NPV is basically the ultimate green light. It confirms that your project is expected to create real, tangible value for the business over its entire life cycle. And finally, we check the internal rate of return, or IRR. It's simple. As long as the project's IRR is higher than your company's required rate of return, your hurdle rate, you've got a really strong signal to move forward. Okay, so once we have this solid financial framework in place, we can avoid what I think is the single biggest mistake people make with AI valuation, limiting its impact to just cutting costs. The true value is so much bigger than that. So the common assumption is that AI is mainly a tool for cutting costs, right? Usually by automating labor. But groundbreaking research on how companies are actually investing in AI tells a completely different story. It turns out the primary driver of growth for these firms isn't cost-cutting at all. It's product innovation. And the data on this is crystal clear. Companies that are investing in AI are seeing way higher growth in sales and in their market valuation, and it's far outpacing any simple productivity gains. So the key takeaway here is huge. AI is a growth engine, not just a cost-saving tool. So to capture this much broader impact, we model everything against 4 pillars. We go beyond just efficiency. We also quantify the new revenue you can get from AI-driven innovation, the risk reduction from better compliance, and that all-important competitive advantage you gain from being more agile. But how do you manage all the risks and those hidden costs that cause 95% of projects to fail in the first place? Well, this is where we need to get a little more sophisticated than a basic spreadsheet. Let's start with your total cost of ownership. It's never just the software license, right? Data preparation alone can be a huge chunk, sometimes 20 to 40% of the entire budget. And then you've got change management, integration. These are significant costs that people often underestimate. So for every single risk, you need a specific control. Is model drift a risk? Of course it is. So you budget for retraining every 12 to 18 months. Worried about low user adoption? You have to invest in proper training and change management upfront. And for governance, you implement things like weekly accuracy dashboards to stay on top of performance. It's all about proactive management. All right, theory is great, but let's make this real. Let's put it all together with a practical example. Okay, let's run the numbers on a classic, an accounts payable automation project. Let's say your initial capital expense is 74,000 euros, with annual operating costs of 52,000. The model projects you'll see benefits of over 95,000 euros a year. So what's the bottom line? A payback period of about 20 months and a positive net present value of over 21,000 euros. See, this is the kind of defensible, data-backed business case that gets a green light. So if you want to build your own case just like this, we've got something for you. Download the Algorythmos CFO ROI kit. It's got a calculator, a one-pager template, everything you need. Then go ahead and book a 30-minute discovery call with us at Algorithms. Let's prove the value together before you scale. Because at the end of the day, AI ROI isn't magic. It's just math, method, and management. And with Algorithmos, we make it CFO proof.